Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. One of the really hot companies in stocks during the pandemic was Fiverr. And while the stock has fallen back a little bit, the company continues to be performing relatively well. It reported earnings this week, and I wanted to dig into the numbers a little bit and show exactly what's going on and what I'm looking for going forward. My name is Travis William. Thanks for watching Rive Investing. Please subscribe here on YouTube for all my content, and let's dig right into the results. You can see here that first quarter 2023 revenue was up 1.5% to $88 million. Gross margin continues to be incredibly strong for Fiverr, over 80%. That's something that I've always been impressed with this company. Active buyers up a little bit, and spend per buyer was up a little bit as well. So think about all the changes that have happened over the last few years. As we go back to more of a normal level of operations, the question I think for Fiverr was, are people going to stop using freelancers or contractors? And it doesn't seem like that's the case. It seems like there are things that they've found value in a service like Fiverr, and they're continuing to come back quarter after quarter. So I think that from a long-term perspective is really positive. The take rate was up slightly. So this is the percentage of each of the contracts or what somebody pays that Fiverr is taking in rev, 30.4%. So probably not a lot of opportunity to increase that. But there was a net loss of $4.3 million, positive adjusted EBITDA of $11.3 million. From a guidance perspective, Fiverr actually increased their full year 2023 guidance just a little bit, at least at the bottom end, $355 to $365 million in revenue. That's 5 to 8% growth, and adjusted EBITDA of 48 to 56 million. That's up from 45 to 55 million. So not big increases, but slight increases, telling us that even management is a little bit surprised at how well its business is doing right now. The other thing I wanted to highlight here is operating expenses. So total operating expenses for Q1 were $79.4 million. That compares to $86.9 million from a year ago. Now, with a lot of these tech companies, as revenue growth slows, the question is going to be, are you going to be able to reduce or at least flatten your operating expenses? And Fiverr's done a really nice job of that, keeping those operating expenses under control. That's why it's still adjusted EBITDA positive, although it's not net income positive. R&D expenses also coming down slightly on a non-GAAP basis, $15.9 million, or 18% of revenue compared to 20% of revenue a year ago. And similar trends with sales and marketing expenses coming down a little bit. The question for Fiverr is going to be really, how sticky can this business be? Are there businesses that are now built on the assumption that Fiverr or a product like it exists? So if I have a small business and I have maybe a team of 1 or 2 people, I'm going to outsource some of the other work that needs to be done. Maybe it's design work, maybe it's programming work, to somebody somewhere around the world. And who's going to connect me to those freelancers or contractors? Well, Fiverr is a place to turn. I think that's fundamentally the bullish case for Fiverr, is that there's going to be a new breed of companies that are built on the assumption that these freelance and contract workers exist, and then you're going to be able to find them relatively easily. I think there's at least signs that that's exactly what we're seeing. The fact that Fiverr is able to grow its user base and revenue per user, even at a time when spending is being cut in a lot of other areas, that tells me that buyers are getting a lot of value from what Fiverr and its freelancers are bringing to the table. And I think that's ultimately really positive. Now, the challenge is whether this is going to be a great investment. Like I said, not profitable right now from a net income perspective. The company has about a $1 billion market cap, also has about $450 million in convertible notes. So this isn't a no-brainer investment, with adjusted EBITDA expected to be in the $48 to $56 million range for 2023. But I think if we start to see revenue turn around and growing more in the high single digits or even up in the teens again, as the economy picks up a little bit more, that's where we're going to be in a little bit more of a position to think that Fiverr is a really great stock long term. So I'm cautiously optimistic with Fiverr, and I'm very encouraged that the company is not declining right now in an environment where you might think they would be coming out of the pandemic. But what do you think of the results? Leave your comments in the comment section below. Don't forget to follow Rive Investing. Thanks for watching, everybody. See you here next time.